Is Ethereum as an investment a better choice than Bitcoin? When I use advanced financial analysis, as in I measure the alpha, I measure the beta, I come to the conclusion that risk adjusted it's not. For me, the price data looks like Ethereum has matured. Any additional performance just comes from additional risk. And so when I look at the statistics, to me it looks like Bitcoin is the better investment. So if you already own any Ethereum, this might be an interesting perspective for you to look at if your investment thesis is only around price data, chart analysis, trends, momentum, and it's not so much about the fundamentals. So in this video, we're not going to look at fundamentals around how gas fees might reduce or how ETH 2.0 might give the community some kind of boost. No, in this video, we only look at historical price data and how the historical price data has now evolved over time. And if we, in case everything stays the same, can expect a risk-adjusted outperformance of Ethereum. I will explain all the concepts I use in this video in detail. If you enjoy this kind of content, please give this video a like. It will help spread the video within YouTube, and so it makes it more worthwhile for me to create this kind of videos and continue doing this. So I want to quickly explain three simple concepts: correlation, alpha, and beta. Correlation is relatively straightforward. It measures how much do two assets move in the same direction at the same time. So within crypto, we have this quite often. When Bitcoin falls, the rest of the market falls as well. There's very high correlation. And so when Bitcoin goes down, everything goes down. When Bitcoin goes up, everything goes up. The way to illustrate this visually is by using a scatter chart. So this is what perfect correlation looks like. On one axis, we have asset A, say Bitcoin. On another axis, we have asset B, say Ethereum. So when in 1 week, Bitcoin goes up 10%, then Ethereum goes up 10% as well. And vice versa, when say in 1 week, Ethereum goes down 5%, Bitcoin goes down 5% as well. This would be perfect correlation. That's obviously not what we see in reality. We see some fluctuation, we see some noise. And so in reality, we would measure something like this. So this data point means asset A goes up around 22% and asset B goes up around 42%. That's this data point over here. And then what we do in order to measure this a bit more precisely is we draw a regression line. That's this line here in green. And so the closer those points are to those regression line, the higher the correlation between those two assets. So that's correlation. Now what's beta? Beta measures how much inherent leverage is in an asset compared to an underlying benchmark. So how much riskier is one asset compared to a benchmark. So let's say we draw a line like this. Okay, that's the prettiest line I can draw here. When one asset goes up by 5%, the other asset goes up by 15%. But the same thing is true for the other direction. When one asset goes down 5%, the other asset goes down 15%. So the asset that we plot here on this y-axis is more risky than the asset we plot on the x-axis. So how would this look like in a price chart? Let's say in red we have the less risky asset. So say this is our benchmark. So that's beta of 1. The riskier asset goes up quicker, but when it goes down, it also goes down quicker. And when it goes up quicker, and so on. So we have more volatility. So this would be like when you have Dogecoin, this is probably going up and down way more than Bitcoin. So if we would measure Dogecoin versus Bitcoin, we would very likely measure a beta higher than 1. So the slope of this line on our scatter chart determines the beta. So in order to calculate the beta, we would just calculate the slope of the line. So in this case, this would be 15 divided by 5 equals 3. So when we expect prices to go up, we should invest into assets that have a high beta. So say altcoins. And the smaller the altcoin, the smaller the market cap of the altcoin, the higher the beta in general. But when prices go down, we want to be outside of those altcoins. We want to shift to Bitcoin. And so what also typically happens is that the market dominance of Bitcoin within the crypto space goes up. You don't have to shift into altcoins to get a higher beta exposure. What you can also just do is leverage Bitcoin. So that's why we measure beta. What we could actually do is when we have an asset of beta of 2 with a perfect correlation, we could simply buy the less risky asset and lever it up by a factor of 2. So we borrow half of the money and get basically double the price exposure. Now what's alpha? Alpha is what everybody wants, and that is extra returns without getting extra risk. So on this chart, alpha would look like this. We have the same risk, the slope is the same, but on average, the asset on the y-axis has an excess return of 7%. So in this chart, alpha is the point where our regression line crosses the y-axis. That's the alpha of the asset plotted on the y-axis versus the benchmark that we plot on the x-axis. So before we jump now into the results of Bitcoin versus Ethereum, what kind of results did I get? I just want to talk about one little thing. It would be great if you could tell the YouTube algorithm that this is a great, useful video. So just put a comment down below. So it would be helpful to know how I could improve those videos. But if you don't have an idea yet, it's also just sufficient to say hi. So just that YouTube knows this video should be recommended to more people on the platform. Thank you. Now I want to show you the results. This is how the scatter plot of Ethereum versus Bitcoin looks like. On the x-axis, we have Bitcoin. On the y-axis, we have Ethereum. And if we draw now a regression line through this chart, we can see a positive correlation. We can see as well that the correlation is relatively weak. So those points are not very close to the line. And so just as a reminder, for example, this point over here means that at some point in time in 1 week, Bitcoin returned around 36-ish%, while Ethereum returned around 39%. That's this point over here. Now, what's the beta of Ethereum? How much more risky is Ethereum compared to Bitcoin? Let's take this point over here. So we have for Bitcoin a 30% return, while Ethereum returns around 25%. And so we've got a beta below 1. On average, Ethereum has been less volatile based on weekly returns compared to Bitcoin. Now that's obviously very surprising, but that's what the data shows us. Okay, but the beta is not really interesting. What's really interesting is the alpha, right? How much excess return do we get on a weekly basis when investing into Ethereum? Now, we can't see this very well here. We gotta zoom in a little bit. So let's just do that. We now look at 10% to 0%. But now let's zoom in even further. Okay, and let's zoom in even further. We get an alpha of approximately 0.7% per week, or annualized an alpha of 44% excess return. So that's very positive, right? So this would tell me risk adjusted, Ethereum is the better bet than Bitcoin. But now comes the catch. I have looked at the correlation coefficient over time. How did correlation between Ethereum and Bitcoin develop over time? And this is what you get. You can measure the correlation coefficient based on a certain time frame, so say 3 months, and then you can roll this correlation coefficient calculation over the price history. And this is what this chart shows here. In the early days, the correlation was all over the place, but then after around half of the lifetime of Ethereum, it became more stable. It became more aligned with the returns of Bitcoin. The returns mimicked each other much more. So that's the 3-month rolling correlation. We can smoothen this a bit out by looking at longer time frames. So that's the 6-month, the 1 year, and the 2 year. So the 1 year chart shows really a clear picture. We had very low correlation in the early days when Ethereum was not that big, when it wasn't really clear that it becomes the winner. And in recent times, it became much more close to mimicking Bitcoin. And the problem is not just that it became closer to mimicking Bitcoin, but that this correlation coefficient is around 0.8, which is very, very high. If we just look at the correlation coefficient, say, of Apple stock versus the S&P 500, we get something like 0.5, 0.6 correlation, which is already high. But 0.8 is unheard of. 0.8 is really, really high. So if we just look at how do prices change, we barely see a difference nowadays between Ethereum and Bitcoin. And so when I saw this, I wanted to update our analysis that we just did. I wanted to just look at the recent data. So say the second half of this chart, only where correlation really stabilized at a high level. So since Ethereum now seems to have matured and to be closer price-wise to Bitcoin, how is now the alpha and how is now the beta? So let's do the same kind of analysis we just did before, but we will only use the price data of the second half of this chart. And this is a scatter plot we get. We get something that shows the higher correlation, so the points are much more in line. And if we now draw a regression line through this, we can see this as well. The points represent this line way better. They are much closer to the regression line. So that is expected. We take the returns from a time where correlation between Bitcoin and Ethereum was around 0.8, 0.9. So what's the beta here? The beta is slightly above 1. So we look again at 20 to 22. The slope of this line is slightly above 1. So that means Ethereum is a bit riskier than Bitcoin. It's also what I would have expected already from the first analysis, from looking at all the price data. But here, if we just look at recent prices, we get something that is also more in line with what my personal intuition would have been. But now let's look at the alpha. The real interesting thing, where does this line actually cross the y-axis? And let's zoom in and we see something negative, minus 0.7%. So that's annualized minus 31%. So just by looking at this data, if you buy Ethereum because you think there's a bull run and you want to get beta exposure, you want to have more price movements when prices go up, and that's why you buy Ethereum, you are paying for this additional beta with an on average minus 31% negative alpha. So what you could do instead is just lever up Bitcoin by 10%. So you borrow $10 for every $100 that you invest. And if your borrowing costs are below 31%, you would make more profits off this riskier leverage trade on Bitcoin. Now this analysis looks at historical data, and the market can change. In fact, it has changed, right? It has changed from a lowly correlated asset to a very highly correlated asset, from a positive alpha asset to a negative alpha asset. And so the underlying drivers for this are based on fundamentals. How many people adopt Ethereum? How does the ecosystem evolve over time? How does now ETH 2.0 play in? So in the end, you need to make your decision based not just on the technicals, not just based on historical price data, but obviously also what you think is going to happen fundamentally going forward. But what I hope you got out of this analysis is that if you want higher exposure to the upside potential in a bull market, and that's your only reason you buy Ethereum over Bitcoin, it looks like this strategy is not optimal. It's probably better to get something that is less correlated, say smaller altcoins, or to even slightly lever up Bitcoin. I'm not saying you have to get into with a 10x, right? Ethereum doesn't have a 10 beta, but slightly levering it up seems to be even safer, or at least seems to, if fundamental stays the same, a cheaper option to get market exposure than to buy Ethereum. If you enjoyed this video, please subscribe. And don't forget, if you haven't yet, to give this a like. Thanks and see you next time. Bye bye.